All right. Good morning. Good morning. Today is Thursday, November 20th, 2025. Welcome to this month's Capital Markets Update and Outlook call. We are live on our website as well as all of our different social media pages. So if you are here with us live today, or if you are watching in the recording, thank you for taking some time out of your busy schedule to be here with us today. For those of you who are joining us for the very first time, my name is Eric Hagan. I am a financial advisor. I'm also president of Capital Consulting Group, or CCG. CCG consists of myself, our Chief Investment Officer Consultant, Tom Fox, who we will all hear from in just a couple of minutes. We also have financial advisors Dan Oshman, Rana Grant, and Jeff Halverson, and our wonderful client operations team lead, Karen Miller. Together, our goal is to help individual investors make their next financial decision, and then the one after that, a good one. One of the ways that we deliver on that commitment is through today's monthly update. Today is an opportunity for each of you to kind of look over our shoulder, get a balanced analysis of what we see, and ultimately to be a more informed investor. We do this in two ways. First, we can help you see your entire financial situation, both today as well as every year into the future, through our personal wealth planning services. After today's message, if you'd like to learn more, I invite you to check out the 2-minute video at clearfinancialfuture.com. And then second, we help our clients get invested right. Being invested right is distinct to every account that we manage. SmartMix is our personalized portfolio solution, whether you have $25,000 or $25 million. SmartMix is our process for helping you get and stay invested right. Again, after today's message, if you'd like to learn more, I invite you to head on over to smartmixportfolios.com. Today, we're going to be hearing from Tom Fox. Tom will review the positives in the markets, the headwinds, as well as give us his outlook for the rest of 2025 and beyond. Ultimately, again, this is your opportunity to kind of look over our shoulder, get an idea of what we're seeing in both the economy and the markets and what we're watching for. So I encourage you, if you have any questions, to put them in the chat box, put them in the comments section. You're also invited to text us or call us with your questions after today's message, or email me personally. We'd love to field your questions. We'd love the opportunity to circle back with you. Tom spends all of his time more behind the scenes doing market research, due diligence, running different analyses, and really focusing his attention on the economy and the markets. He has almost 40 years experience building investment strategies. He has an impressive long resume, as you can see on the screen. And as always, I'm very excited to have him here with us today. So again, at the end of today's message, we will have some Q&A. So if you're watching online live today or in the recording, please feel free to post any questions that you have in the comments section, and we would love the opportunity to answer those for you. So with that, I will bring our theme for 2025 back up onto the screen. I will bring Tom into our presentation here. Good morning, Tom.
Good morning,
Thanks for being
Eric.
here with us today. As always, very excited to hear what you have to say about what's going on in the markets and the economy. The times continue to change.
Yes, and I think we're having a mini change right now, and we'll be talking more about that. We got the major changes that are occurring, but there has been just recently sort of a mini change. I think it's very temporary, but we'll get into that as we go through the presentation.
Very good.
And as always, we always like to start off with the big wall of worries, the uncertainties out there, and there's plenty. And number one on the list is, Eric, high valuations. The S&P 500 forward earnings is around 22, a little over 22. Of course, that compares with the 18.6 average 20-year and 10-year average. So we're up above the average and PE ratios, which is a measure of valuation. However, in this market move, in this bull market, we're seeing earnings, the E part of the price earnings, which is growing faster than expected. So as long as those earnings, those corporate earnings keep coming in, I think we're going to be okay, but it doesn't leave a lot of room for error. Of course, also we have the AI spending sustainability. This is the one that's this mini change that's going on, the sentiment towards AI stocks, where investors are now questioning, hey, are they going to get the profits, the revenues from these huge amounts of investments into AI? And so now that has been rattling through Wall Street. And of course, it's brought a lot more volatility and a downward pressure, especially in technology in the AI area. Another concern is the consumer sentiment. It was a historic low. How are consumers facing the higher grocery costs and other inflationary things, and the weakening labor market? So the sentiment right now is very low. In fact, it just hasn't been this low since June of 22. And so that is something we are watching. But it's a very volatile number. We could see it go up again next month. So we need to see a trend in the consumer sentiment. Tariff-driven inflation risks. Goldman Sachs put out a piece that they think that 50% of the burden is going to end up on the consumer for all the tariff, which is a higher number than what is expected. I think the jury's still out on that, what exactly the consumer will be picking up. But that is certainly a risk that's out there. And then, of course, a potential for the Fed pause. And we're going to look at a graph on this, Eric, where it shows that the probability went from over 90 down to below 60. So we're going to see where exactly that probability is today. It's dropping, that they're thinking that maybe the Fed is going to be on hold, which, of course, if rates are dropping and the Fed's lowering rates, that is good for stock market. However, if they are holding, and of course, the ultimate reversal would be if they started talking about raising rates. That's not out there yet, and we'll be talking more about that and giving our opinion on that. In the recent market valuation weakness, or a weakness we've seen in the price, S&P's come down. We've over 3% or 4%, and then the Nasdaq's down over 6% from its record high in October. So we haven't seen a correction, and I think as we look forward here, that this pullback is actually healthy and normal. So we'll be talking more about that. But it has pulled back, which is showing some weakness, and it goes around the AI spending and sustainability question up above. And then, of course, we have warnings of correction. Goldman Sachs, David Solomon says he could see a recession or a big pullback in the market over the next 12 to 24 months. That's 1 to 2 years. I could make that forecast too, Eric. Something's going to happen within 12 to 24 months. But of course, there is that risk out there. But right now, we're not seeing all of the things that need to come together for that to become a reality. And then we have the government data uncertainty. What is it going to show? We're going to probably skip a month on some of the data, so we don't know what happened. And of course, the data we've been getting is not as reliable as some of the government data, and that's going to be starting to unfold now. So there could be some shocks in the data. It could be positive, could be negative, but we don't know yet, but that's out there. And of course, the Fed's mandate or target inflation, not a mandate, but their target is 2%. And we've been hanging around that sticky 3%. So are they gonna lower rates? Are they gonna hold where they are until they start to see that begin to head towards 2%? So that's not positive for the stock market, but it's not disastrous either. And then we have the market concentration risk. We've talked about this many times, about how just 10 companies dominate the capitalization weighting of the S&P 500 index. So if one of those companies or a couple of those companies stumble, it could bring down the whole index because it has such high weights in that upper area. Well, there's always a reason to be in stocks. Why should we own stocks today? Well, number one, and this is a big reason, is that strong corporate earnings growth. We're seeing growth continue to surprise to the upside in earnings, and it's in fact it's double digit again, and 26 we're expecting even double digit again. So right now, with the corporate surprise to the upside in the third quarter, and we'll probably the fourth quarter is going to be interesting because the government shutdown is going to impact some companies. But we'll show you later in our presentation that we think the GDP will go down or maybe even negative in the fourth quarter because of the government shutdown. But we'll have to see as we go ahead. But we certainly have surprisingly strong corporate growth. And then, of course, the balance sheets, lots of cash with the companies strong. They're not over leveraged. We're seeing corporate America sitting on a record cash, healthy free cash flow, manageable debt service. Of course, right now there's something interesting going on where these big AI companies, tech companies, are starting to raise money through debt, which they haven't really had much debt, but this is a new phenomena to build out their dreams and their vision for AI. But right today, there's corporate America looks really good. And then we have the AI infrastructure boom continues. There's 11 major AI infrastructure deals that have unfolded recently. They're expecting $500 billion in investing in infrastructure for AI. It is the future. And of course, that's a big part of the economic data piece, and it's driving our economy. And then we have bull market characteristics remain intact. Well, what's bullish still today? Well, there's nothing out there that we see that would point to a recession. And there's currently nothing that would point to the Fed's raising rates or some. Now, we can't forecast external geopolitical shocks. You can't forecast that. But there's nothing what we see in the bull market characteristics that would point to an end to this bull market yet. Now, we're watching all for those signals, but right now we don't see anything out there that would begin to point to a big economic turndown and so on. Another good positive is that the market breadth is improving. We're starting to see some broadening out, not just the Big 10 that are performing, but even in this recent pullback of especially those Big 10 tech stocks, we're starting to see other companies do better on a relative basis. So that's a good sign. That's healthy for a continuation of the bull market. And of course, we have coming in 26, the big, beautiful bill, the one big, beautiful bill is coming, and we have fiscal support. We've got a tailwind of things, lower regulation coming to companies, a lot of incentive to keep investing. And we'll have some charts later on our presentation talking about intellectual property expansion, which all ends up leading to a positive to the economy, where we see the economy continue to grow. So we got a lot of money being invested, all in tech areas. So this is an exciting time to be alive as we move forward. Another positive is resilient consumer spending. The consumer continues to show healthiness, and we got a chart on this, but they're continuing to spend, especially in the middle and upper incomes. So this is a good sign because 70% of our economy is the consumer. So this is a really important segment of the spending. Now we see the manufacturing potential also stage a recovery. We're starting to see U.S. manufacturing, and this is going to continue over the next several years, primarily because of the current administration's desire to bring manufacturing to the U.S. But now we're starting to see it expand. We're starting to see it in the numbers, but this is just the beginning. That's all good for our economy. And of course, we have the last thing: historical patterns favor continuation. We got strong gains historically. A bull market that has done what it's done recently tends to, and we'll see some graphs on this later, tends to keep going. So we think it's not going to die of old age without a clear catalyst. And as I've said, we do not see a catalyst to bring this market down.
A bull market in motion tends to stay in motion
Yes.
without anything getting in the way. A strong list of positives there, Tom.
Thank you.
Let's see your details.
All right. Well, let's look at some graphs that support what I've been talking about. Recent AI tech pullback. You can see the information technology. And that was through 11/13. It's come down further than that. We've got tech down, I think, over 6%. The NASDAQ's down over 6%. But you can see that the winners, which were communication services, industrials, and consumer discretionary information tech, are now the losers in this pull down from the peak. And you can see it shifted over to healthcare, which has been a long laggard. And that, reason we own some healthcare stocks in our wide moat is to bring balance and to get diversification. But you can see energy, materials, consumer staples, and financials, we like financials, have been all positive during this pullback. And the biggest hit, of course, is in infotech and on the AI specifically. And it's gone down a little further than that. I would not be surprised, Eric, to see a correction in NASDAQ or the information tech. I wouldn't be surprised. It would not bother me because I think it's healthy and very normal. We can see those kind of moves, and then it just sets up a next leg for the bull market. Now, Jeffrey Gundlach, he's a bond king, huge bond manager, well-known analyst and portfolio manager. He sees private credit as the next big crisis. Now, he tied private credit going down to the stock market. I'm still trying to figure out the connection there. But obviously, if there is a disaster in private credit, then it would impact the stocks in the long run. So, but he's thinking this could be like the 2008 mortgage crisis if it keeps going, because we're seeing so many players enter. And I've been saying this to our advisors. I've been saying stay away from private credit, because when you have too much demand and there's only so much supply, what happens is that to build the portfolios, you're getting less quality. So I've been recommending to stay away from private credit. I think it could be a big problem there. You just have too many people and going after the same thing. And typically, when you see private credit going to retail, Eric, to the retail market, that's when you run, because the institutions love private credit. But when it goes to the retail, that's not a good sign, because what they're saying is we need to raise more, we need more money, but there's plenty of money in the institutions. I always question when these institutional products end up in retail. That's not normally, in my career, been a good sign.
Okay.
However, the bull market may still be intact, and we believe it is. This is the recent 6 months ending in October at that high. You can see it was the ranked third since 2000. That's 25 years. This was a pretty big move over the last 6 months. There's been two that have been bigger, but it's up there, and this has been historic. And typically when you get this kind of a move, as we've been talking about, things in motion tend to stay in motion. So I think that this is something that's really important. Okay, this is a very much of a positive. There's seasonal strength historically during this November to January and December to February. And you can see historically what the 3-month returns have been for different periods in the calendar, and since 1950. But what it shows is the October to December, the November, the January, which we're in November right now, have been seasonally very positive for stocks. And at the Y2 axis on the right, it shows that you have those pluses signs are marking what percent have been positive. And you can see the November to January has got the second highest positive return probability in throughout history. So we think seasonality points to the stock market doing well through January or maybe even February. Here's another positive, and this is really what drives corporate returns, stock returns, is earnings, and we've been talking about it. But you can see that each year, what the market was saying, where they thought the growth was going to be at, and you can see it is turned up. That little blue arrow on the right in 25, it's come down. They thought it would be below, but now it's going back into double digits. So that's positive. In fact, in 26, it's still going to be pointing to double-digit corporate earnings. And we haven't even seen how we're at the very beginning stages on how AI is going to impact companies, their profitability, and their productivity and efficiency. So we're at the very beginning of that. And we think it's going to translate into better earnings as we go forward. So this is a positive sign for the stock market. This chart shows the most recent quarter, the third quarter, but Eric, look at 85% beat their estimates, and by a huge margin, 7%. Those numbers are big. That's with 92% of the companies, of the 500 companies, reporting. So what we're seeing is this third quarter was bigger than expected. This is all positive for stocks. So we don't think this is going to go away. Now the government shutdown is going to have a temporary impact, maybe on airlines and some other areas. They won't get that back because people didn't travel as many people travel as much, but it's going to turn around, and we're going to look at what we expect to happen in the second quarter. But the fourth quarter will sort of be a one-off, I think, because of the government shutdown. We'll see how much it impacts it, but I wouldn't put a lot of weight on it. I would look at the first quarter of 26 as we go forward. So resilient economy. This is showing the estimates going up. You can see it's been slightly going up here, the number of the estimates as we go through the calendar. On the lower, that's 25, but look at 26. That's two heading in the same direction, slightly growing the estimates for the overall per share, S&P 500 earnings per share estimate. This is positive. That's a big increase. And so what we're saying is we've had great numbers in 25, but the 26 numbers are expected even to be better. All right, the A revolution is still intact. And here's JP Morgan, Mary Erdos, which is an analyst, portfolio manager for JP Morgan. She's one of the top people at JP Morgan investing. She says AI isn't in a bubble, but rather it's in an opportunity mode. And we kind of agree with her. So we have the Gundlach on the one side, we have her on the other, JP Morgan on the other side. This what makes this so exciting, Eric, in our business, because you got people on both sides. One saying there's a disaster coming, the other saying it's an opportunity. But I tend to agree with JP Morgan that this downturn is an opportunity for AI. And we can see in the numbers for the third quarter that tech had the largest contribution. You can see the size of that, 21%, and 57% of the contribution, and 21% growth. So these numbers are still dominating all the other sectors. We do like financials. We have financials on our sector rotation strategy. So we like financials as well. We like utilities. They're going to power the future of AI. So a lot of this is pointing this. We don't see this diminishing on a relative scale too much. Of course, it's hard to build on numbers that are so big and keep compounding at those rates. But this AI movement is just in the early innings. You can see this with the capital spending. This is just 1, 2, 3, 4, 5 companies. What they're $500 billion. They're going to be investing AI data centers and other things. This is huge. What's happening today and why the market pulled back with all this investment, are they going to get revenue out of this? Are they going to get profitability out of this big investment? And of course, they all think there will be, because AI is the future, and we're just figuring out how to use AI, and it's just at the early stages. So this is the question: with all this massive investing, will they get the return on their investment? And so that's we're not going to know that for several years, but I think it will ebb and flow as we go through 26. Now, here's intellectual property. What is that? It's software, research, and development, all-time highs. This tends to really end up causing growth in the economy. When you have this kind of historic software, research, and development, and intellectual property, this tends to end up helping GDP growth down the road. Technology, things are changing fast. And what's happened, this should all produce a better economic outcome. And you can see what the expectation, where we are even now, intellectual property become a greater part of the economy. These big investments, you can see it's been growing on a relative of it's started at 2% of the GDP, but now it's going to 6%, and that's going to keep climbing, because we're in a new AI revolution. It's going to change everything down the road, but it should help economic growth in the coming years. Now, people talk about, you probably, Eric, have seen a lot of comparison to the 2000 bubble and technology, and then today's. And are they equal? We don't think so. This is an interesting chart, because remember, Cisco was the big winner in that 1998 to 2000 period. And what it shows is the price growth, but it also shows the PE ratio, the valuation. Now compare that with this move with NVIDIA. You can see that the price has moved up similar, but look at the PE ratio. It has been going sideways down on the green bar, the green line down below on NVIDIA. If you can highlight that, I don't know if you can, but you can see that down here. That's been going sideways. So why is the price going up, but the valuation continues to hold steady? It's because the earnings and the revenue are real. Cisco was bet on the come. This is not happening. These AI companies, especially NVIDIA, really is not even overvalued. And so this is a huge comparison, which drives home the difference between the 2000 and the current tech move.
That is a stark difference.
All right, history points the bull market continue as well. Now, these are a number of bull markets that have occurred. 3, 6, 9, 12 bull markets here. And what you see is how, all starting with $100, what did it go up? And you can see where we are right now, Eric, is the red line. And you can see it ends right there, and it's come down a little bit from there. But you can see there's been a number of bull markets that have continued. So you can see all these bull markets. We're not necessarily at the late innings of this bull market. We'll have to see. You can't forecast that kind of future. But what we believe is that we still have room to run in this bull market. And this chart really brings it home based on other bull markets to compare with. Now, what about the annualized returns? You can see this was showing when we reached that peak in October, but you can see where we are in comparison to other bull markets. There's been 4 bull markets that have had, this is not the duration, this is just the current magnitude that we're looking at here, annualized per year. And you can see there's been 4 others that have had even higher annualized returns than this particular bull market. And so this kind of tends to say, hey, we're not out of line. This bull market has run quite a bit. And this pullback, we're excited about the pullback. Eric, I'm very excited about the current pullback because it's an opportunity to reset and then build on the next phase of the bull market. Powering the future of AI. This is a big one. We've been picking up more companies in the wide moat. And also we have positions in the tactical thematic that are pointing to, hey, we're going to need more data centers. You can see that it's going to be the billions of dollars that are going into it. You can see that non-residential structures, X data centers, is now just the data centers going to dwarf all other flows of money. And this is many people are investing in data centers. Now, I think they're down the road. It's too early to tell, but there will be some winners and there will be some losers. But I think right now, this is pointing to the future of AI. Something's got to drive the AI and empower it. And so we think this is just such a growth area. Lots of money going to data centers. What does that mean? The next chart points to the deficit here. You can see the demand where it's going. These are estimates going into 2030. This is our supply. We see the gap between the green and the orange. That's a large gap. That means lots of money is going to go into power, electrify the world, and especially America. And so there's going to be huge nuclear and other forms of energy production. And there's all kinds of companies that are going to benefit from that. But this is a need that's going to be around for a while. So there has to be a huge build out of providing the power for all the AI energy needs. All right, the consumer, we talked about one of the reasons to be in stock. Consumer has been resilient. This is broken out in 3 different areas. We have the sub 75,000 income, then the 75 to 250, and then over the 250. You can see 75 to 250 has been higher than it's been since 23. The consumers continue to spend. And you can see that the problem has been in the sub $75,000 income range that's caused problems. But Eric, what I notice is the trend. It's moving higher from its lows last year. So this is a good sign. So the consumer today is not showing the kind of information that we would need to say, hey, this 70% of our economy is pulling back. It doesn't appear in the numbers. This is all good signs that this economy will continue to keep going. Now, there's been a lot of argument today, and we'll look at the first chart, probability of rates going down. They're saying one from 95.5 back in October to 1 month later, it's about 50%. It's even dropped a little further than that the Fed will not cut in December. They still have a couple cuts in 26, but right now, this has been going down, down, down. Our opinion, my opinion, is that they will cut, Eric, in December, and here's why. Job growth. Remember, there's a dual mandate for the Fed, not only keep inflation down, keep prices stable, but also to reinforce the labor market. And so the Fed's eyes are kind of looking at inflation with one eye and the other eye is looking at the labor market. And right now, this is ADP, private payrolls, Some say it's not as accurate as the government numbers, but remember we've been in the blind. We can't see what the government numbers yet, but they're going to start coming out. We'll see where they're at, but there is a definite trend in the private markets, private payroll market, heading that it's approaching stall speed. Still positive. It hasn't gone negative, but it's kind of at stall speed. I think the numbers are going to point that the labor market continues to weaken. And as a result, because of the dual mandate, our expectation is the Fed will be forced to drop the rates another quarter, even though it's maybe under 50% right now. We're thinking it will be another cut coming in December. That's all good for stocks as we go forward. Now, what's happening and what's the AI impact on labor? Right now, it's showing that most of the layoffs are coming from government. This is part of the weakening. This is part of the DOGE initiative to get rid of waste, inefficiencies. And so there are a lot of government layoffs. Some of them have been voluntary. Some of them have not. But right now, the government is a big part of the job cuts. But we've seen AI at 6%. Our forecast is that AI component, I think the government percentage is going to come down, but I think the AI could double or triple over the next 3 or 4 years. So it's already becoming a big piece in the job cuts for reasons, but I expect that to continue, and that AI will replace a lot of jobs, and we'll see how that shakes out going forward. But this is something to keep an eye on. So what's the impact of the government shutdown? We've talked about it, but this is what is expected now. JP Morgan put this out, and what it shows is that the gray was what was expected before the government shutdown, and now after the government shutdown. So the GDP growth may go negative in the fourth quarter. However, look at 26 first quarter. There's a massive rebound, bigger than the difference between the lower GDP. So don't be surprised by a low or even negative GDP number, but don't focus on that. We want to focus on what happens in the first quarter of 26. I think this starts the bull market, will be a good catalyst for the bull market as we go into 26, starting in the first quarter. Gold. Everybody's talking about gold. I'm sure you get a lot of calls, Eric.
Yes, I've had many calls about gold. Yes,
gold
sir.
Historic run. Now we didn't own it, but look at the gold's huge rise from safe haven. But now, based on this chart, annual price, we're seeing this as speculative now. So I'm a little risk adverse when it comes to gold. Typically, it's an important diversification mechanism for your portfolio. And so what I would have been advising is that don't sell your gold, but don't buy it either. Don't buy more, or don't enter the market at this point. I'd wait for a pullback. Some saying it's going to go to 10,000. We'll have to see. But no, I would not be a buyer of gold here, especially at these levels. And I think it's become now speculative. All right, here's our updated outlook. I made some changes here. Many of the things we've said that would happen did happen, but as I've already spoken, the government shutdown hits fourth quarter, but no recession. Large reacceleration occurs in the first quarter of 26. Stock market volatility remains high due to the shutdown, especially the impact maybe on the earnings in the fourth quarter, and of course some of the company's narrative. And AI worries that are out there, will they be able to make money on all this investment? I don't think that's going to go away. That will be there. So volatility will be high. Inflation rises, CPI remains sticky, temporary impact by tariffs, but we expect inflation is going to retreat and head towards that 2% in 26. We may not see that immediately in the fourth quarter, but I think starting in 26, we're going to start to see a rollover of the inflation numbers towards the Fed's target. Fed keeps cutting rates, we think, December, due, as we said earlier, to the labor weakness, their dual mandate. Of course, bonds have had one of their best years, not relative to the S&P 500, but they've done pretty well recently in a long time. And we think that will continue because we think the Fed will keep cutting rates as we go forward. We think stocks will outperform bonds, though, in the long run here. We remain bullish. We see the current weakness as a buying opportunity. Catalysts, fiscal support, easy monetary policy, AI-driven productivity gains are all coming together and aligning. So we still think that the bull will continue. And we think AI stocks will recover the recent pullback. And I don't know if they're going to go to new highs, but I think that it's possible that they could go to new highs. So we're high quality technology and AI beneficiaries recover recent pullback, close out strong in 25. And we're still holding to our achieving the S&P 500, achieving a 10 to 20% return. Now I put all these wild cards together, the geopolitical event that could rock the market. We can't forecast these, but there are assassination, Middle East escalation, U.S.-China trade and tech conflict, global shipping choke points, disruptions, and here's one, the election instability. We got midterms coming next year. And so that will all that hype will begin to increase as we go forward. And then we have possible cyber attack, commodity energy shock, Russia, Ukraine, and so on. So they're all out there, but you can't forecast those. But we are monitoring all these things to see if it would change our view of the market. So that's our overall. We remain bullish. We look at this pullback as opportunity.
Awesome, Tom. Thank you as always for the in-depth, balanced view of the weight of evidence approach that you take. We really appreciate it. It's just it's a lot to take in. And with that, I invite anybody, if you have any questions, you have an incredible resource here in Tom. If you have any questions, you can post them in the comments section. You can email me directly. You can text our office number now, and we get text messages to our office number. And you're also welcome to pick up the phone and give us a call if you have any questions. However you want to send your questions, we'd love to field those for you. As you contemplate submitting a question, a couple of things here. I will have the recording on the website here for today's message this afternoon. Also have a summary that you can download if you'd like the Cliff Notes, or a button there, a tool you can use on the website if you'd like to ask a question more anonymously or just individually and not in a public forum. So that will be up here on the website shortly. For those of you that don't know, I start my week off every Monday morning with a short 3, 4, 5, sometimes 7, 8, 9 minute kind of summary of what happened in the markets the previous week, some of the things that we're looking for, some things that are happening around the office, or things to be looking forward to. So if you're not joining me, would love to have you. Again, 9 a.m. Central Standard Time. A very short update to kind of keep our thumb on the pulse of what's happening. Also, I have a save the date for everybody. So our next monthly update is scheduled for Thursday, December 18th, and it will also be our 2026 outlook. And so look forward to this every year. Tom often has an announcement of the theme for the year. Tom, are you thinking about that? Are you prepared to say?
I have been thinking about it. I haven't come to my final conclusion.
Oh, so you've got some contenders though. Okay.
Yes.
So would look forward to that. Would love to hear what that theme is. I think it was the last 2 years we kept the theme the same because things were
Yes, we
delayed a
did.
year ago, right?
We
Yeah.
did. We kept it the same, and I can say that things have been changing quickly, and so I
Yes.
think it's been the
Well,
right theme.
you
And
got
I
the theme
actually, I
exactly
think
right
it
on.
will continue to change, but because we've had this for 2 years, I got to come up with a new one.
All
So,
right. I wasn't going to put any
so we'll
pressure
come
on
up
you,
with
but
a
I
new
think
one.
that's a good idea. Wonderful. Because, one could argue that things are always changing, right? So can't.
They say, Eric, there's one constant in this world, and that's change.
Yeah, very, very good. You're exactly right. Yeah. So save the date. We'd love to have you. There is the event is on the website. If you'd like to, there's a little tool there. You can drop in your name and email, and you will get a reminder for that message. We are going to be hosting this one online for December, and then looking forward to perhaps a nice in-person lunch type event to kick off the new year in January. So watch for that. But right now we are scheduled for Thursday, December 18th. That will be 11 a.m. Central Time on our website, on our social media pages. So we hope that you'll join us as Tom talks about the outlook for 2026 and perhaps revealing a new theme looking forward. So with that, I'm going to check a couple spots here for any questions. Tom, I don't see any questions. If you have any closing thoughts, love to hear them. Otherwise, I'll wrap us up.
Yeah, I would expect volatility to remain on the higher level as we go forward here. And there's going to be some companies, some sectors that have been impacted by the government shutdown. But typically, what it does, it creates more volatility. But then they'll look forward. The stock market, the investors will look beyond that into 26 because now the government's up and running. So that's a one-off for many companies. Now there's some like airlines where people just didn't fly because they couldn't. That's a one-time thing too, but it does impact the fourth quarter as we go forward. So I think also that we remain bullish. There's nothing that has changed our minds, even in this recent pullback. So we're very positive on the market, and we're looking not just to end at 25, Eric. We're looking through 26. So right now we're very bullish on going forward. So we look at any pullbacks as potential buying opportunities.
Well, I've noticed in my conversations with people over the last few weeks and month here, there seems to be some growing fear. So really appreciate the calmness and the objective approach that you bring to today's message. So thank you very much, Tom. Appreciate you as always. Thank you for those of you who joined us, whether you joined us live here today or are watching the recording. We do appreciate you taking the time. And I can't stress enough, if you do have any questions, you have an amazing resource in Tom. Feel free to email, text, send a message, however you'd like. We would love the opportunity to circle back with you. So with that, I will say thank you, Tom. Thank you to all of you one more time. And that concludes this month's monthly capital markets update and outlook for November 2025. Bye, everybody.